We're speaking on the eve of the Jackson Hole Symposium, the annual gathering of economists and central bankers from all over the world. And of course, in the spotlight this year, as always, will be Federal Reserve Chair Jerome Powell making a speech and giving his outlook on the economy and monetary policy. And joining us to discuss this is Gary Wagner, editor of thegoldforecast.com. Gary, welcome back to the show.
Thanks so much for having me.
We have you on yearly, well, every year around this time to give your outlook on exactly what's going to happen, because usually they've been pretty accurate, your predictions in the past. Let's take a look at this year's theme. It's called Reassessing Constraints on the Economy and Policy. The symposium will be held on the 25th to the 27th of August, so starting tomorrow. Before we get into your projections for this year, let's take a listen to one of the clips from last year's symposium. And we'll take a listen to what Jerome Powell said about inflation.
The rapid reopening of the economy has brought a sharp run-up in inflation. Over the 12 months through July, measures of headline and core PCE inflation have run at 4.2% and 3.6% respectively, well above our 2% longer-run objective. Businesses and consumers widely report upward pressure on prices and wages. Inflation at these levels is, of course, a cause for concern. But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. This assessment is a critical and ongoing one.
You know, I remember the days when 4.5% inflation hit and everybody was panicking that things would get a lot worse. These days, one can only wish for 4.5% inflation, Gary. But his statement that inflation was still temporary at the time, this was in August, mind you. So let's do a recap of that statement last year. And obviously, we know that inflation did tick up higher. So how would you make that assessment, and how would you assess the remarks and the outlook of the Federal Reserve based on those statements alone?
Absolutely. The Federal Reserve Chairman Powell got it wrong, really wrong. The idea, that inflation was transitory, that it would subside naturally in a short period of time, was the worst assumption they could have made, because their actions were based upon that, and their actions were really inaction. In other words, they didn't start raising rates till March of this year, and at that point, inflation had already risen to about 7.5%. So they've been playing catch up from the get-go.
What about his assumption, or not assumption, but his statement that there are no signs in the economy that could point to higher inflation? In theory, was he right? I mean, we do know that inflation ticked up higher eventually, but one could argue that perhaps some exogenous forces, unforeseen, could have caused higher inflation, and actually the economy at the time didn't actually show any signs of inflation. Looking back, was that right?
Well, obviously, looking back, it wasn't. The problem that the Federal Reserve was faced with is that it was a unique set of circumstances that took us to where we are now, to where we were last year. And that is that the primary cause of inflation was supply chain bottlenecks. And this was coming out of a recession. We then had a pent-up demand. We couldn't fill orders, so to speak, or businesses couldn't. And so the fundamental argument that he had was so wrong, it was 180 degrees the other way, that any action he took actually, I believe, made the scenario worse. It didn't in any way alleviate the problem. It let it get out of control quicker and let inflation move higher than anyone had anticipated.
The Federal Reserve started raising rates exactly when, Gary? Let's recap for the audience.
Well, that would have been March of this year at the FOMC meeting. And I believe that we were at 7.5% by the time they did their first rate hike of 0.25%. It was followed by the next 3 FOMC meetings. They had in May, 0.5%, 50 basis points, and then 2 concurrent 0.75% or 75 basis point rate hikes in June and July.
Mm-hmm. If I recall, I think there wasn't consensus amongst all Fed governors to raise rates or wait. at the last Jackson Hole Symposium were around that time. Am I correct? I mean, it wasn't that everybody wanted to wait, and it wasn't that everybody wanted to go ahead with rate hikes right away, right? I think there was, at one point, I don't remember which month, but at one point it was a pretty split consensus.
Yeah, if you have to look back at the last Jackson Hole Symposium, inflation was sitting at about 5.5%. What half of what it rose to when we went to 9.1, of course, we went down to 8.5 last month. But at that point, they were still under the illusion or assumption that inflation was transitory, that it would work itself out of the system naturally, and they didn't really have to implement any tools from their toolbox, as they call it, to get a handle on inflation to bring it down. It would just naturally occur. And that assumption was so wrong that it led to all of the issues we're dealing with now, which is having a level of inflation at 9.1%. That is a 41-year high. At 8.5%, it's still a 40-year high. That's the last time we have seen it. So many individuals have never seen inflation at this level.
Well, okay, so you're right in the sense that they did make some wrong assumptions, and the tape was pretty clear there. But Gary, the other assumption that you're making is that had the Fed done something back then, maybe inflation wouldn't have been as bad as it is now. So can you make the assessment confidently that had they started raising rates right after Jackson Hole or around the same time last year, that maybe inflation wouldn't have gone to 9.1% this year?
I think that's a reasonable assumption. Of course, there's no way to know, but I can say this. If they had begun with small rate hikes of 25 basis points a year earlier, they could have had a series of them that wouldn't shake the economy as quickly and as hard as it has by contracting the economy, by raising it from virtual 0 to 2.5% over a 4-month period of time. If you would do that over a 2-year or a 1.5-year period of time, it would have been possible that we would have had inflation that wouldn't ratchet as high as it was. But I still believe even if we did do that, we'd still be looking at an inflation level of 5 or 6%, which we would love to have now. I don't think it would have alleviated it completely because we had all kinds of wild cards come into the geopolitical economic arena, so to speak. And once the invasion by Russia into the Ukraine and what that did to the price of oil, that was kind of like a second stage booster on a rocket, and that rocket was inflation.
Sure.
And once that ignited, we went into double time. We started having inflation tick up much quicker and much faster with greater rises each month.
I mean, the Ukraine crisis did put the Fed in an even tighter spot than they were already in, because think about it. Yes, supply chain problems coming out of Eastern Europe may have exacerbated inflationary pressures, but had the Federal Reserve raised interest rates even more, or had they been starting to raise interest rates before that and then hiked it up even more following the invasion of Ukraine, they could have slowed the global economy down even more, right? So maybe at the time they were wondering to themselves, what do we do? Do we just let it stew for a bit, see what happens, or do we do something now, risk slowing down the global economy even more, but possibly control inflation? Maybe that's what they were thinking.
If you listen to some of Chairman Powell's statements over the last couple of months, he's acknowledged that they should have acted sooner. And that's his words. How much would have it changed the overall picture? No one knows. But what we can say is the fact that there were new issues thrown into the mix. And besides the war in Ukraine, we had the lockdown in China. So we had an exacerbated supply chain issues because of that. They shut down cities at one point. So these are things that no one could have seen coming. And so you can't argue that the Fed didn't act quickly enough over those instances because no one saw those coming. But I really do believe had they started to use their toolbox much sooner, we wouldn't be looking at inflation sitting at 8.5% today. It might only be 6%. It might not be. I don't think he would have taken it to 4 or even the target level of 2 to 3. But yeah.
Another thing we'll listen to is Powell commenting on wages and his projection on how wages would impact inflation. Let's take a listen.
We also assess whether wage increases are consistent with our 2% inflation goal over time. Wage increases are essential to support a rising standard of living and are generally, of course, a welcome development. But if wage increases were to move materially and persistently above the levels of productivity gains and inflation, businesses would likely pass those increases on to customers, a process that could become the sort of wage price spiral seen at times in the past.
All right, so Gary, my question is, given that inflation was as high as it was, and given that wages actually did tick up despite Powell's forecast last year, do you think wages were a critical component in pushing up inflation to 9.1%, the highest we've seen this year?
I don't know if I'd say critical, but what I will say is it was a very important and large piece of the puzzle, because we got to where we're at because of multiple events occurring and multiple actions either being taken or not being taken. And the fact of the matter is that higher wages definitely added to the inflationary pressures we see now. Critical, I would have to say that it was extremely important and added substantially to the level of inflation we're currently experiencing.
All right. Well, we've looked backwards. Now hindsight's always 2020, Gary. Now you did call for higher inflation last year, so in terms of calling for inflation, you were technically more accurate than Fed Chair Jerome Powell. But let's look forward now. This year, again, the agenda of the conference will come out tomorrow. But the theme is reassessing constraints on the economy and policy. What do you think will be some of the major talking points to be discussed this year? And what do you think will be announced in terms of the Fed's outlook on the economy and inflation?
Well, Powell is going to have to thread a very, very thin wire through an even smaller hole. He's going to thread the needle so that he gets his point across, but doesn't sound too dramatic. The thing that we have to realize is that when we look at solving the problems we have now, the only thing we can really look at is past occurrences of high levels of inflation, what was done to curtail that inflation, and what was the length of time it took for the economies to return to a normal level of inflation, whether it's 2 or 3%. So you have to really look back into the 80s when we had double-digit inflation. We also had double-digit interest rates. So we had a scenario in which we had incredibly high levels of inflation that were dealt with exorbitant interest rate levels. And even then, it was a multi-year process to take us back to what we call normal, a normal level of inflation, a target level 2 or 3%. So what he's going to do, of course, I believe, is he's going to try to assure the American public that they understand the hardships, 1. 2, that they have tools in place to mitigate the problem, and that they're on the ball. In other words, they're at their desks working on it. That's the message he'll probably come out and make. But what are market participants hoping to hear? And I think the main thing they want to understand is, at what point will the Federal Reserve stop raising rates? What's the target they want to get to? And then even more importantly, at what point will they start to unwind that? In other words, reduce Fed funds rates rather than raise them. And if we get any inclination in terms of a timeline, I will be surprised, because I don't think he wants to buttonhole himself into a corner and say that, well, by the end of 2023, we'll be reducing rates. But I think that his main message is going to be to assure the American public that they have a handle on it. Now, whether or not the American public believes that is another story. but that's going to be, I believe, his central theme. And the question is how high will the Fed raise rates before we really start to see interest rates move down on a regular basis and sizably? Because when we look at it, there's been only two occasions, I believe. Once when it went from 8.5 to 8.3, this was a year ago, and then the recent downtick of 9.1 to 8.5. Other than that, we have had consistent upticks in inflation levels for the last year. And so 1 month where inflation comes down does not really make a trend. And so that's what the American public want to see. They want to see it actually having an occurrence that they can count on.
Okay, well, speaking of pivot, several mainstream economists from large institutions have been calling for a Fed pivot. For example, Marko Kolanovic, he is the global economist at JP Morgan, put out a note earlier this week, and it's been making headlines. Basically, he said that inflation is going to work itself out and ultimately drive the stock market higher. I'm just reading an article by Markets Insider. And as oil prices fall and supply chain bottlenecks resolve, the Fed will eventually have to pivot. So his view, like some others, the Fed will have to pivot because inflation is just going to solve itself. Do you agree with that?
To a large extent, the inflationary pressures that were caused by supply chain issues and the high level of energy will subside on a natural basis. I have to agree with that, because for essential components like energy and food, raising rates doesn't have the same kind of effect on reducing demand as luxury items, as items that people can choose to get or not get. And so supply chain issues have to work themselves through and have to resolve themselves naturally. How long that takes, I don't have an answer for. Mm-hmm. And will it naturally occur? That's, to me, an obvious. That is how it works, because you have supply chain issues. Factories start to get fully staffed. They start producing the products that people want and shipping them out. And so those issues do work themselves through the system. Yes.
Okay. The last point I want to bring up regarding the Fed is at what point do you think they'll start addressing unemployment? Now, recall that the unemployment rate is still very low, hasn't ticked up yet, or at least have given people signs of worrying. In fact, if you remember, last jobs number was very strong.
Huge,
now,
yeah.
Do you think at a certain point this year, this is going to have to be an issue for them to address directly?
At a certain point, realize that we're coming from a point in time when there were 2 vacancies for every individual looking for a job. There was a massive amount of jobs available, double that of the people looking for jobs. So once that equalizes, where there's 1 job for every 2 people looking for it, that will change the equation, and that's when that will become a concern. And that will happen, but it's not something that I believe is immediately on the horizon.
Fair enough. Okay, let's turn to gold now, your specialty, your expertise. Gary, the gold price has been flat all year. I don't have to remind you or the viewers who follow the gold market very clearly. Do you think this Jackson Hole meeting is going to significantly impact the gold price in either direction, do you think?
It easily could. And I do have to take contention with saying that gold has been flat throughout the year, because when I look at a chart, I don't see it that way. I see a major rise up until March, when it goes to $2,077. It's the high of the year. And then March happens to be the point in time when the Fed implemented its first rate hike. And as they implemented more rate hikes, gold went down further and further till it hit a bottom. And I believe that bottom was in place at $1,680.
Yeah.
Technically,
right. I should have specified. Yeah, it's flat year to date. We're slightly down, but you're right. It did at one point go above $2,000, and then it came very briefly, very dramatically back down. But yeah, please continue.
So my personal take is that once it hit 1680, the market was extremely oversold. I think that there was genuine interest that came back into the market, and that's what has bid gold prices higher. I think that right now I'm looking, first it's got to obviously test 1800 again, 1830. I believe there's resistance in that area. I believe that there's support right now at around 1734. But the key to what we witness in gold more than anything has got to be the dollar, because that's the one part of the equation we haven't really addressed yet. The dollar hit a 20-year high. And when it goes, the dollar index went to 109. When you look at it on a really long-term chart, a 2-month chart, you can see the last time that the dollar index was at 109 was moving up to 120. That happened in 2000, and moving from 120 way down to 73, and that was in 2003. So 109 is in a technical area where there really hasn't been any kind of historical top or bottom there. So if it continues to get strong, it's going to continue to weigh upon the price of gold. And that's been the number one adversary of gold moving higher, faster. If the dollar actually begins to subside its tremendous growth spurt that it's had, we have a real opportunity to see gold go a lot higher than just $1,800.
There's a view that if the stock markets move dramatically in either direction, that could impact the price of gold. If you assume that gold is somewhat of a hedge against volatility in the risk asset space, possibly if Jerome Powell were to make a statement that is more hawkish than anticipated, that could really dramatically move down the stock markets. Potentially, we could see a gold surge. Is that true, Gary? Do you think that could happen?
That's very possible. The one thing that I've noticed recently that is a fairly recent occurrence is we used to have that negative correlation between U.S. equities and gold. Gold did well. The stock market was going down. It was safe haven play or risk on play. What we've seen over the last year, because of the increased volatility, is when the stock market would go into a deep correction, gold would follow with it and go in the same direction down. Many people thought it was because it was just mass liquidation of assets to cover margin calls to get back into cash. But I think that if we see Powell's tone be extremely hawkish, I think that it would have a dramatic impact, a negative impact on U.S. equities, and it could also have a negative impact on gold at the same time.
All right, so what's your base case scenario for gold in the next couple of months based on the charts, based on the technicals?
Depending on the hawkish or dovish change in tone that we hear from the Jackson Hole Symposium, I think if gold continues to rise, we could break back above 1800, 1830. The brass ring is 1880. We have a major top there. If we have a tremendously hawkish stance, by that I mean they start announcing that, well, full basis point rate hikes are not out of the question, and we'll have multiple rate hikes of a percentage over the next couple of FOMC meetings. That's going to be a different story, because what happens then is yields go up, it makes the dollar go up because it attracts, the dollar becomes a safe haven asset rather than gold. So if you get an extremely hawkish tone where they're talking about accelerated sizes of the rate hikes, that could be an issue for gold. The play will be in yielding assets such as treasuries, notes, and bonds, and that, of course, will boost the dollar. It's going to be about the dollar, and the dollar is going to be based upon how hawkish or dovish the Federal Reserve is perceived to be once Fed members are interviewed this week, and, of course, the keynote speech by Chairman Powell.
Fair enough. All right. Well, thank you for your preview and thank you for your outlook, Gary. And we'll see if the Fed is right or wrong. And time will tell. Thank you, Gary.
Time will tell. Thank you so much for having me.
And thank you for watching Kitco News. I'm David Lin.